Hello, this is Clint, Larry's analyst over at the Opportunistic Trader. I hope everyone's having a great day and you are enjoying the holidays. As one thing we want to do as we get closer to the new year, whether it's myself, Larry, or Eric, we want to come to you on the podcast and start thinking about and discussing, some of the big themes, some of the big ideas that's going to define 2026. And probably one of the biggest questions on everyone's mind right now is the state of stock market valuations and if we are in a bubble. And so, look, a bubble is just any time an asset value or something that's at least perceived to be an asset rises significantly above and beyond its intrinsic value. And so, for the stock market, the way we look at that is to compare the level of stock prices to earnings. And so there's various ways to measure earnings. And so that's how you can compare, where the level that something's trading at relative to earnings to identify if we're seeing bubble-like characteristics or not. And so that's what I want to do today. I want to go through several charts, look at several ways of valuing the market. I'm going to look at the market really broadly, look at the S&P 500, look at the entire market capitalization across the stock market and compare that to different measures of earnings and show where we are relative to certain points in history and why this is a bubble and what the implications of a bubble are for you as an investor if you have money at stake. All right, let's start with the PE ratio. The PE ratio, price to earnings ratio, is probably the most popular, most common way to value a stock or an index like the S&P 500. And so that's what we're looking at on here. This chart comes from JP Morgan, and it shows the forward PE ratio for the S&P 500. So forward PE ratio means this is taking expected earnings over the next 12 months and comparing them to the current level of price. That's what this grayish line on here is plotting. Now, this gives us a little bit of history. This goes back to 1994. And so you can see how this line has evolved over time and where we are currently. So the latest valuation measure ratio based on the PE has us at 22.4 times. That is well above the 30-year average of 17.1 times. So you can see the average is this middle dashed line going across the chart here. And then this plots one standard deviation above and below that average. So you can see we are approaching some interesting levels here on the forward PE ratio. One, we are right back to slightly took out the highs that we're seeing in the PE ratio at the peak in 2021. So we're right at the level where the stock market reversed lower at the end of 2021 and went into 2022's bear market. That's what the subsequent drop is here. And we're only below levels last seen during the last big bubble in the stock market, which was the internet bubble in the late 1990s. And so you can see where we are relative to that bubble, approaching those levels. So, this is one valuation measure that is well above historical averages and is approaching levels that, looking back historically, at least over the last 30 years, has marked a major peak in the stock market. One other one I want to look at is something called the Buffett ratio. So Warren Buffett coined this ratio. First spoke about this back in, I think it was 2001, I believe. During, the 01 was, we're right in the middle of the internet bubble bursting. And what this does is this takes the value of all publicly traded stocks and divides it by GDP. So this creates a ratio, again, by looking at the value of all publicly traded stocks over GDP. And so similar to how you might look at and say, a company's that market capitalization relative to its earnings, while you're looking at the total value of the stock market relative to the total value of the economy. And by this measure, we're at levels that we have never seen before in history. So you can see this chart. This comes from longtermtrends.net. This chart goes back to the 1970s, plots the average for this indicator since then, which you can see on average, this indicator has been below 100%, meaning the value of the economy is greater than the value of the stock market. When this indicator starts to push above 100%, that's when the value of the stock market is running higher than the value of the economy. And you can see, I mean, we're well over 200% currently. We just poked over 100% back right before the 2008 financial crisis. You can see where we were during the internet bubble. So, the last chart we looked at, you can see the PE ratio was higher during the internet bubble, while by this measure, we are more significantly more overvalued currently versus the internet bubble. Also taking out levels seen just before the last bear market, that would have been the 2021 peak right there. So by this measure, again, looking at the market value of all stocks relative to the size of the economy, we are at levels never seen before. One other way I want to show this is to take that Buffett indicator and make it a scatter plot against something called the Shiller CAPE ratio. So what does CAPE stand for? This is the cyclically adjusted price to earnings ratio. And I know that probably sounds like a mouthful to say, but it's actually a pretty simple indicator. Intuitively, it makes sense. What it does is it takes earnings for the S&P 500. So this is for the S&P 500, takes earnings and averages them out over a decade. So the thought process is you want to smooth earnings out over a full business cycle. So take an average of earnings over the last decade and plot that over time. And what this chart does, Paulo put this together, is it creates a scatter plot of that cyclically adjusted PE ratio against the Buffett indicator that we were just talking about. And it pulls and compares this to some other interesting time frames throughout history. So we have 1987 plotted on here, but then more recently, you can see where we were in 2007, ahead of the 2008 financial crisis, where we were during the last big bubble in stock prices. And one thing I want to mention about 2007 really quick, we had an asset bubble there, but it wasn't necessarily in stock prices. It was in the housing market. And in 2007, stocks really weren't significantly overvalued relative to history. So we really didn't have the hallmarks of a bubble in the stock market heading into 2008. Again, I mean, bubbles can show up in different asset classes, and that back then it was in housing. But 2000 was the last time you had bubble like valuations in the stock market, and you can see we are running at a level pretty similar right now on the cyclically adjusted PE ratio, but once again running well above anything we've ever seen based on the Buffett indicator. All right, so last chart on kind of the valuations I want to walk through. So we've talked about PE ratio, we talked about CAPE ratio, we talked about this Buffett indicator. Well, what I think is interesting with this chart, it comes from Bloomberg, is that they took and made I'll call it a composite valuation indicator based on a number of things. So you've got a trailing PE, forward PE, you have the CAPE ratio we just talked about, price to book, price to sales, EV, EBITDA, and so on. And what this does is it makes a percentile ranking. So, relative to history, where does this fall in a percentile ranking for each of these indicators? And then averages them. And it's pretty remarkable. They take this all the way back to 1900. And if you take this really broad look at valuations and where this stands currently, we have never been more expensive based, again, collectively on this measure. We got close to it. Here's 2021 again. We're now exceeding that level, well above where we were in the late 1990s, ahead of the dot-com bust. What's interesting is I believe this is 1929, so ahead of the Great Depression, so running at levels that are even higher than what we had in 1929 ahead of the Great Depression. So again, just the weight of the evidence. Again, what's a bubble? It is when the price of something it's pushed well above and beyond its intrinsic value, and by multiple measures. We are seeing that in the stock market today, and so what are the implications of this? Well, here's the thing, you can sit here and say it's a bubble, but it is tough to pinpoint exactly when the bubble is going to go bust. In timing that, I have some thoughts on that. I'll share that in a subsequent video. But the thing, so near term, it's hard to know when exactly this is going to hit, and that makes sense because what the research shows, what the data shows, is that over the near term, for periods of say 12 months and in, valuations have very little impact on stock prices, especially when you're looking at the index level. So if you're looking at something like the S&P 500, so talk about the S&P 500. If you're looking at valuations, if your holding period, your investment horizon is 12 months and in, valuations matter very little. I mean, it just ends up being noise at that point. That's why, a lot of times when we're talking about trading, we don't talk a lot about valuations because it doesn't have that big of an impact if your holding periods measured in less than a day, to days, or even weeks. It doesn't matter. But when it does matter is if you are a buy and hold investor, if you've been conditioned over time that what you want to do is hold the SPY ETF or QQQ, this is where you really need to pay attention if you have money allocated for the long term. And that's because over the longer term, valuations matter very much for forward returns you tend to realize. And that's what this chart on here is showing. So what this is showing is annualized returns for the S&P 500 over a 10-year period relative to where the S&P 500's trailing PE ratio was to start at that period. And so what you can see this downward sloping line. You can see that there's a correlate. If we were looking at this 1 year in N, this would look like, someone shot this with a shotgun. I mean, there are these black dots everywhere on here. But as you start to extend this time frame, you start to look out 10 years, 5 years out, 10 years out. This is looking 10 years out. You start to see this relationship. And what it shows is when you're buying at a cheaper PE ratio, a lower PE ratio, those returns over the next 10 years, annualized on average, tends to be fairly positive. But as you start to get more expensive, as that PE ratio starts to rise, your return gets less and less. And what's interesting is when you start to go above 25, when you look at instances where the trailing PE ratio on the S&P was above 25, you have this cluster of returns below zero. This is a negative territory. So imagine that. I mean, over 10 years, on average, each year earning a negative return. Right now, as I'm recording this, the trailing PE ratio for the S&P 500 is at 27. So, we're at that level. So this is where you would need to really sit up and pay attention. Again, if you are a longer term investor, this is the danger, the challenges, the headwinds, so to speak, when you're buying at valuations at these levels. And it's hard to not want to get caught up in the euphoria when the market's rallying. And again, it's hard to time exactly when this is going to matter for the market, but eventually this is going to catch up. We have these bubble-like indicators, and when you are buying at these types of valuations over the longer term, that can be very, very risky. All right, that's all for me today. Again, I hope you're having a safe and happy holiday, and we will be back to you with more thoughts on 2026 and some of the catalyst events and things that are going to shape the year ahead.